Welcome, everybody. Merrill Chandler here. Breaking news so you don't break the bank. Today's topics are a variety, all about lenders, all about what lenders are doing right now in as they kind of hedge against inflation, and how the government and lenders are actually, in one instance, collaborating now because of COVID actually revealed some strengths that lenders had in certain communities. So let's get to it. First of all, first thing we're going to talk about is the demise of NSF charges. These are for non-sufficient funds. These are the bounce fees, commonly known as bounce fees. The non-sufficient fund fees, returned item fees, are largely a thing of the past, quotes the American banker, among the top 20 banks. In the top 20 banks, there are, however, a few holdouts, and one of them being Huntington Bank, the largest lender for SBA loans in the country. Huntington Bank is out of Columbus, Ohio. But what's interesting is that this is a wonderful move for mostly all of us are served, right? But since in our master course, also known as the boot camp, we teach about the new zero, how to stay away as far away from possible from zero. And I'm going to say this again every time we address this topic. It's the easiest solve. If you have not done so, you must call your bank. You must close your check guarantee account, your non-sufficient funds account, your bounce guarantee account. And then you need to tell your bank, disregard and reject every single transaction, whether it's a debit, a check, a draft, whatever the transaction type, an auto draft, whatever it is. You need to tell them to reject anything that puts you through zero. This serves in two ways. Number one, you don't trigger any negative borrower behavior tracking with that lender. Do you realize one single bounce check will eliminate the credit limit increases if you have credit cards with them? It gives you a negative relationship with that bank for a minimum of 6 months. 6 months. Because if you don't know how to manage your own money, then they're not going to want to give you their money. So make sure that you close your check guarantee accounts, and then instruct the bank to flip the switch, whatever it is they need to do to reject any transaction that causes you to punch through zero. Reject the transaction. It's better that you're embarrassed with Netflix bouncing or at a restaurant than it is for you to ruin your relationship for a minimum of 6 months with that lender. Then once you tell them to do so, you're going to call back and ask a new customer service rep if it's already been done. You need to confirm that twice. We never accept anything as the truth until we hear it from 3 different people 3 times, right? So make sure, do not, I just had one of my friends have an auto deposit that did not get registered. She asked them to put it on auto deposit. It didn't get done. And then she went 30 days late on a payment and ruined her credit. So you guys, every single thing you verify, make sure 3 different people give you the same answer, and make sure that account is flipped, because then that is the only protection you have. Now, what's interesting is more and more banks are getting rid of the fees. But what they're not saying is that they're still tracking how you treat your money. So if you're going through zero, they may not be charging you the $35 anymore, but they're still counting you as being a poor manager of your own funds. Make sure you go through this process. I'm telling you, man, it's a simple thing to do and has such high positive impact on your fundability. All right, next then, And I want to acknowledge Sky Copier, my producer and content manager, for culling a number of articles for me to review and make sure that we give you the late breaking news. The next thing we want to talk about is that there are CDFIs. Okay, a CDFI is a community development financial institution. So during the pandemic, part of one of the bailout bills was where the administration empowered more investment, loan investment into disadvantaged communities, right? And these disadvantaged communities don't necessarily have the same access to capital that we have. And so different, all kinds, tier 1, tier 2 lenders, Bank of America and Chase were big into offering these loans. But these loans are parceled out that you have to be in certain zip codes in order to qualify for these loans. Some of them small, some of them large, but these community development loans are backed by the federal government. Well, they proved out these loans, the default rate was way smaller than predicted, and the use of the funds for community development has augmented, and as a result, the CDFIs are now saying we want access to more capital. Now remember, the Fed, the home loan banks, there are different federal affiliated organizations and/or the Fed can offer these types of loans to banks with the guarantee that by the federal government for their repayment if they go into default. Well, they're asking, the American banker literally says it's becoming a burgeoning political force in the nation's capital, and some of the sector leaders, some of the CEOs of these big banks are saying, give us more access to these because it's a higher than normal return, because the default rates, as I said, are lower than they anticipated. So they're like profitable loans in these disadvantaged areas. So it's a win for everybody. Lenders win when they lend, and we've had almost 3 years worth of track record for these types of loans in these communities. And so it's a win for the communities because the communities are getting low cost loans that are underwritten and guaranteed by the Fed. So, or by the feds, by the administration. And so this is becoming a taxing part of the win for lenders is that there are tax incentives to lend to these communities. And so it's becoming a really powerful opportunity for the banks. And if there's an opportunity for the banks to win, the communities are definitely winning. So be on the lookout. We'll be talking more about that. Everything that we're doing here at Get Fundable is to help borrowers and future borrowers. The 50 million currently unbanked, these, which is where we lead into our next, our next kind of article or announcement that's going on out in the marketplace. Now, there are the invisibles. Let's redefine our terms. A credit invisibles, or the unbanked, is a body of consumers that are not borrowers yet, and not borrowers in the sense that they use check cashing loans at high interest rates. They use, if they have a vehicle and it's paid off, they use title loans. They use and their check advance, they're borrowing, they're using their check as their only asset. And so they're borrowing in extremely heavy, high interest penalties for doing. And so one of the administration's big pushes is to give credit to the credit invisibles. The FICO and and lenders have been working behind the scenes long before the administration. Everybody recognizes 50 million potential borrowers is a big ass deal, right? So they want, everybody in the system wants to get access. So some of the different credit bureaus, as well as FICO, are measuring alternative data. They're taking rent payments and tracking those, and then their utility bills, cell phone bills, because faithfully making a payment is faithfully making a payment, right? It's a borrower behavior, even though it's not a traditional credit instrument. So think of it as two tiers. If you're a member of the current credit economy, then you have a traditional credit card, doesn't matter if it's secured or unsecured, a traditional credit card. You may have an auto loan, you may have a mortgage, and all of these report to the three bureaus. Let's call that a tier one borrower, right? Then we've got consumers who literally have no checking accounts, no savings accounts, and use their check as their asset. It's the collateral against which they borrow in these check cashing and or check advance loan places, right? So these are tier two. Now, these tier two consumers, potential borrowers, do not have traditional credit, so it can't be measured by traditional FICO monitoring, measuring, and by lender underwriting software. So the use by FICO and among others to start tracking all these different types of a service provider is what we call them. A service provider trade line would be a rental lease payment, a rental payment, cell phone, utilities, etc. So this what they're calling alternative data, still demonstrates the fastidiousness of borrower behaviors of borrowers, and that is what a new score, both Experian has one, Experian Boost, FICO Ultra is monitoring some of these other data points. Traffic in your checking account is FICO Ultra's. Now, there is also on deck to measure these alternative behaviors. The issue is that they are not part of the tier one traditional credit reporting process. That is limited to individuals who have credit accounts that are part of the current credit system. But these invisibles, consumers with a tarnished or no credit history, can now build their profiles by demonstrating stable cash flow, especially and on-time payments with these different alternative accounts. So I'm just keeping you posted. The software I'm developing is designed to reach the credit invisibles, help them understand how to. Nobody, even current credit folks, don't even measure faithfully how to stay as far away from zero as possible. Nobody has taught that tech until now, right? Until Get Fundable. So everything that we're doing is designed to also reach and create intelligent borrowers out of what are currently the credit invisibles. So more and more people are, more and more institutions are making their service provider payments, cable payments, utilities, et cetera, available to be reported, captured, and reported on, to make these credit invisibles also part of tier one credit industry. So more movement is happening there, and it is becoming it's really catching its momentum, and I'm thrilled to see that more and more people are getting on board. I just want to make sure that we as credit people, especially us who are looking for credit lines, business loans, business credit cards, and to be strategic borrowers, these types of trade lines do not help us. But if you're listening and you are currently not a part of the larger credit system, then this type of reporting are all going to help you build a true credit profile measured by the 3-digit FICO score and lender software to help you get into mortgages, the best homes, auto loans, and credit cards, especially business credit. So this is Merrill Chandler. Thank you for joining me. We'll see you next time at this same time and place, Tuesdays, 3:45 Mountain Time, and love to have you join us to stay up to date so that you can have the news and so that you can protect your fundability. Thank you.